In this video, I'm going to demonstrate our single stock mean reversion template. What this template does is it applies the concepts of mean reversion to a backtester to allow you to test trading strategies and trading indicators to optimize your profitability. After downloading and opening this template, we'll navigate to the Start Here tab. Here, you can enter your application key in the yellow cell. After that, we'll navigate to the Main tab. In the Main tab, we have all of our controls, our charts, and our statistics for our trading strategy. In this top right chart, we have our close price for the stock in blue. We have our estimated trend in yellow behind the blue. And then we have periods in which we're either long or short the stock in green or red bars respectively. Below that, we have a chart of our normalized detrended spread. This is a much simpler chart than the name will imply. The blue line is the adjusted close price of the stock divided by the trend minus 1. This allows us to see what percent above or below our actual prices are from the trend. Below that, we have our normalized detrended spread percentile chart. Again, though this chart's name is wordy, it's relatively simple. On this chart, instead of plotting the spread itself as we have above, this plot shows how often the spread has reached a certain level. If the spread is higher than it ever has been before, the chart will reach 1 or 100%. If it is lower than it's ever been, it will reach 0%. This is the chart where trading decisions will be made. We sell when the blue line crosses the red, and we buy when the blue line crosses the green. We exit when a day lands between the two yellow lines. We can adjust this red line using our high percent threshold cell here. We can adjust the green line using the low percent threshold line. And we adjust the yellow lines using our percent release. As we change our trading rules, we'll see this chart on the left change to reflect the profitability of our strategy. There are also checkboxes that allow us to tell the backtester to never short the stock, never go long the stock, or invert our trades, meaning to buy when we normally sell and vice versa. I'll go over why this might be handy in another video. Now that we've gone over what all of our charts mean, let's try to find a tradable spread. For more information on tradable versus untradable spreads, check out the mean reversion video linked below. In this example that I have below, we have a tremendously tradable spread. The stock price regularly jumps above and below the trend, and when it does go above or below the trend, it tends to top out in the same places, and it tends to bottom out in the same places. Now let me show you what an untradable spread looks like. Instead of this eval window of 17, let's change it to 70. You can see that instead of the nice symmetry we had before, this spread tends to have a trend of its own. And you can see that its movements don't repeat themselves and they're not as dependable as they were before. Additionally, the tops regularly are different from one another as well as the bottoms. Now let's go back to our old eval period of 17. And now we'll go over some of our statistics down here. Starting capital, ending capital, and total return are pretty simple. Total days are the number of days from our start date forward. Our traded days are the number of days in which we have a position on. And then our percent of time trading is just traded days divided by total days. One thing that's important to consider about mean reversion trading is that depending on where you set your indicators, your red and green lines, you may be trading only 10, 25, 40% of the time. During the times you aren't trading, you have the opportunity to utilize your capital in other ways. If you have mean reversion setups on multiple stocks, you'll find that some stocks present trading signals while others are flat, allowing you to remain active year-round. Others may prefer to place their money in an index fund or some other basket of stocks and use mean reversion trades as a means to juice their returns. And this all leads into why there are two numbers for our annualized returns. Our traded days annualized returns are based on the traded days number here, or the numbers that we have a position on, and our total days annual return is based on the total days. So for our total days figure, this is the return you'd achieve every year if you kept your money in cash when there weren't buy or sell signals. The trading days annualized return figure is the return you'd achieve with a year's worth of buy and sell signals. This number is important because it represents more clearly what your annual returns would look like if you overlapped multiple mean reversion setups. Days winning are the number of days that the strategy showed a positive return, and the opposite is true for days losing. Remember that this isn't the number of winning trades versus the number of losing trades, but a tally of the number of days up versus down. In mean reversion strategies, say you buy at the 8th percentile and the stock may trend down to the 4th percentile before reverting back to 0. In fact, a winning trade could have more losing days than winning days, if the winning days are of greater magnitude. That's why it's important to look at our win percent in connection with our average win and loss percentages. Here our average win and loss are about the same, but we win 58% of the time. And days flat is the number of days that the strategy had to trade on, but that the stock's price didn't change. The regression average error is the average difference between the trend and the stock. Our aim is to have this number be relatively low, but also remember that if it were 0, there would be no spread at all. Max drawdown is the difference between our highest peak and our lowest valley. So say that the portfolio climbed to 1.1 million and fell back to 1 million. This would read negative 10%. It's important to watch this so you don't expose yourself to too much volatility. In this example, you can see that for a little bit more than 1,000 days, we've returned about 33%. On the total days basis, that's 7.3% per year. But on a trading days basis, that's an almost 50% annual return. And that's only trading 18% of the time. Now imagine that you decided to index your money using the SPY ETF on the other 82% of trading days. If you captured only half of the SPY's returns over that period, your total return would be over 62%. That's 12.6% annually over more than 4 years. Here are some other setups that I've thrown together. For Apple, you can see that based on these trading rules, we only trade 10% of the time, but we achieve a 42% return. And now on a traded days basis, that's a 141% annualized return. And even on a total days basis, that's over 9%. Now we're only winning a little bit more than half of the time, but when we do, it's much greater than we lose on the days that we do so. On top of that, our maximum drawdown was only 6%. Now compare this to many other strategies or funds that you could allocate your money to, and you'll find that this strategy tends to be much less volatile. I've decided to click on the never short sell because Apple tends to have some days where it unexpectedly jumps on news and things like that. That's hard to predict, so to avoid any sort of downside volatility as a result of being the wrong way on a good day for Apple, I've decided to click on never short. I decided on the eval period of 7 days with a little bit of trial and error. I started out high with 30 or 40 days and worked my way down until with my base high percentile threshold and low percentile threshold, we had some nice profitability numbers. From there, I brought them in a little bit. Now I'll show you a strategy on Tesla. In this setup, we have much greater volatility than our last strategy, but our returns are pretty amazing as well. Our total return is 128%. We've traded about a third of the time, and on an annualized basis, that's over 81% a year. Even on a total days basis, that's 22% for more than 4 years worth of trading. Our win rate's about 57-58%, which is pretty good. You know, there aren't very many 80-90% indicators out there in the market. What you really want is an indicator that gives you that consistent little bit of edge. And our average win and average loss are pretty close to one another. Now, like I said, our maximum drawdown was 33%, but our total return is much higher. So this is a much more aggressive strategy, but the total returns have been pretty impressive. Here, I've adjusted our high percent threshold up to 99, which is almost like having never short on, with the exception that it does short when the stock price is very high above its trend. I've also changed the eval period to 12 days. Again, this is based on a little bit of trial and error. I start high, 30, 40, 50 days, and I come down. I tend to go a little bit below where I end up, and then I work my way back up to somewhere that's comfortable. For my last example, we'll check out an auto stock, so I'll put in GM. So the results of this example are higher than our Apple setup, but they're lower than our Tesla setup. And the volatility, or our max drawdown, is somewhere in the middle as well. Again, like with Tesla, our high percent threshold's pretty high. So this is almost like having never short on, but with the exception of very extreme circumstances. One thing that's interesting is that our eval period is more than double that which Tesla's was, and more than triple that which Apple's was. Even though we have a significantly different eval period, though, our regression average error is less than that which we had for Tesla. This means that the trends which generally affect GM are much longer term than those which affect stocks like Apple and Tesla. Here, though, we still have a pretty impressive return, 72% over our 1,030 days. We've traded a little bit less than 1/3 of the time, and on an annualized basis for traded days, it's a 62% annual return, and on total days, that's 14%. So even if you just put your money in cash during the times where this strategy told you not to trade, you'd still make 14% year over year for more than 4 years. This is a similar winning percent to our other strategies, about 58%, and our average win, again, is similar to our average loss. There are tons of stock picking gurus and newsletter services and Other companies like that will go out and they'll advertise, our signal is right 90% of the time, 95% of the time, even 80 or 70. But the fact of the matter is that A, those signals tend not to exist, and B, if they did have them, they wouldn't be selling them to you for $29 or $39 or $129 a month. They'd be running their own hedge funds. Strategies which really create consistent profits are those which gain a generalized edge, a little bit of an edge on the market, and when they're wrong in about the same or less magnitude than they're right. What we're looking for is consistent profitability. Thank you for watching this tutorial. For more of this content and access to an insane amount of live and historical financial data, try out Trade Defender for free by visiting our website, tradedefender.com. Use the offer code REGRESSION for 25% off your first month. For any questions or comments, please contact us at support@tradedefender.com. Thank you.